If you look at the raw economic numbers, the United States looks like an unstoppable machine. We have states that are generating so much wealth that they literally outperform entire countries. If you look at a map of the gross domestic product, or GDP, there are 10 states that stand out above all the rest. These 10 states are effectively the economic engines of the entire continent. They are the places where the biggest companies in the world have built their headquarters. They are the places where the stock market creates millionaires every single day. They are the places where innovation happens, where technology is invented, and where culture is defined. Collectively, these 10 specific states control more than 60% of the entire United States economy. Think about that for a second. Just 10 states are doing the heavy lifting for a nation of 50. On paper, living in one of these economic powerhouses sounds like the ultimate dream. It sounds like the winning lottery ticket. The narrative we are sold is very simple. We are told that if you want to be successful, you have to go where the money is. We are told that proximity to wealth equals access to wealth. So we pack up our cars and we move to these massive GDP giants. We move to the coasts. We move to the big cities. We chase the big salaries and the big opportunities. But in the year 2025, a strange and disturbing paradox has emerged. The states that are making the most money for the country are often the same states that are making life impossible for the people who live there. Rich state does not mean rich resident. In fact, for the vast majority of the middle class, living in a so-called rich state has become a financial trap. We need to stop looking at GDP as a scorecard for our own well-being. GDP is a measure of corporate velocity. It measures how fast money moves between banks and businesses. It does not measure how much of that money stays in your bank account at the end of the month. It does not measure whether you can afford to buy a home. It does not measure whether you are one emergency away from bankruptcy. Today, we are going to look at the top 10 richest states in America, but we are not going to rank them by how impressive they look on a spreadsheet. We are going to rank them by the brutal reality of what it actually costs to survive there. We are going to expose the hidden taxes that eat away at your paycheck. We are going to look at the insurance crises that are quietly destroying household wealth. We are going to look at the cost of living that makes a six-figure salary feel like minimum wage. We are going to peel back the glossy layers of the American economic miracle and look at the math that actually matters to you. This is the reality check that nobody talks about when they look at the headlines. Let's start our countdown at number 10. Number 10 is New Jersey. If you look at the official rankings, New Jersey is an absolute beast of an economy. It generates over $850 billion in GDP. It is one of the wealthiest states per capita in the entire union. The median household income in New Jersey is nearly $97,000 a year. That is significantly higher than the national average. If you just looked at that one number, you would think that everyone in New Jersey is living on Easy Street. You would think it is a paradise of upper middle class stability, but there is a catch. There is always a catch. New Jersey has the distinct dishonor of having the highest property taxes in the entire United States of America. This isn't just a little bit higher than average. It is aggressively, painfully high. In 2024, the average property tax bill in New Jersey broke the $10,000 mark. Let's contextualize what that actually means for your daily life. Let's say you do everything right. Let's say you work hard for 30 years. Let's say you pay off your mortgage completely. You own your home free and clear. You don't owe the bank a single dime. In most places, that is the moment of financial freedom. But in New Jersey, you are still writing a check to the government for nearly $1,000 every single month. You never truly own your home in New Jersey. You are effectively renting it from the state government forever. And if you stop paying that rent, they will take it away from you. This high tax burden bleeds into everything else in the state. It pushes up the cost of rent for tenants. It pushes up the cost of goods and services. You are paying a premium for the privilege of being close to New York City and Philadelphia. But are you getting a premium experience? Many residents would argue that you are getting congestion, aging infrastructure, and a cost of living that makes it impossible to save for the future. New Jersey is a prime example of a state that is rich on paper, but expensive in practice. It extracts wealth from its residents just as fast as they can earn it. Now let's move west to number 9. Number 9 is Illinois. Illinois is a true titan of the American economy. With a GDP of over $1 trillion, it is the economic anchor of the entire Midwest. Chicago is a global financial hub. It is a center for trade, for agriculture futures, and for logistics. The sheer amount of money flowing through Chicago every day is staggering. But beneath that surface-level wealth, Illinois is drowning. The state is facing a fiscal crisis that has been building for decades. Illinois is the only state in the country with over $100 billion in unfunded pension debt. In 2025, that number is sitting somewhere around $143 billion. Why should you care about pension debt? Why does a number on a government balance sheet matter to your personal finances? It matters because debt has to be paid. And in a state government, there is only one source of revenue to pay that debt: you, the taxpayer. When you live in Illinois, a huge portion of your taxes is not going toward improving your life today. It isn't fixing the potholes in your street. It isn't improving the schools your children attend. It isn't upgrading the public transit system. That money is going toward paying for promises that politicians made 30 years ago. You are paying a premium today for the mismanagement of the past. This creates a heavy drag on the entire state economy. It creates uncertainty about future tax hikes. It drives businesses away. And it is a major reason why Illinois has seen a population decline in recent years. People aren't leaving Illinois because they hate the weather. They are used to the winters. They are leaving because the math simply doesn't work anymore. They are tired of seeing their property taxes go up while their property values stagnate. They are tired of feeling like they are on a sinking ship. Moving on to number 8. Number 8 is Pennsylvania. Now, Pennsylvania is an interesting case on this list. It is a massive economy crossing the $1 trillion GDP mark. It has diverse industries, from the pharmaceutical hubs in Philadelphia to the robotics centers in Pittsburgh. It has a lot of old money and a lot of industrial history. But compared to the other states we are going to talk about, Pennsylvania is actually somewhat of an outlier. It is relatively affordable. You can still buy a nice house in Pennsylvania for a reasonable price, especially once you get outside of the main city centers. So why is it on the list of traps? Because rich state can be a misleading label. While Pennsylvania has a massive GDP, it suffers from slow growth. It is not booming like the Sunbelt states. It is not attracting massive waves of new young talent like the tech hubs. It struggles with what economists call brain drain. For years, young people would go to the excellent universities in Pennsylvania and then immediately leave to find jobs in New York or California or Texas. Recent data shows this might be slowly reversing, but the structural issues remain. Living in Pennsylvania often means dealing with an aging population and an economy that feels stuck in second gear. It is a place where you can afford a house, but you might struggle to find a significant raise. It is a place where stability comes at the cost of opportunity. It isn't a financial death trap like some of the others, but it certainly isn't the gold rush that the GDP numbers might suggest. Now let's shift gears completely. Let's head down south. This is where the narrative shifts from old money to new money. This is where everyone in America seems to be moving. We are told that the South is the land of low taxes, big houses, and freedom. But be careful. Sometimes the price tag is just hidden better. Number 7 is Georgia. Georgia has exploded in recent years. They call it the Hollywood of the South. Atlanta has become a massive corporate command center. The airport is the busiest in the world. The GDP is nearing $900 billion. But Georgia suffers from a massive split personality. If you are in the wealthy northern suburbs of Atlanta, the economy is booming. But if you drive an hour in any direction, the wealth drops off a cliff. Georgia has one of the highest rates of income inequality in the country. And even for the people who are making good money in Atlanta, the quality of life is taking a hit. The traffic is legendary for being some of the worst in the nation. The urban sprawl means you spend hours of your life sitting in your car. You are trading your time for a lower mortgage payment. And that lower mortgage payment is disappearing fast as home prices in the metro area skyrocket. You aren't necessarily getting a discount in Georgia anymore. You are just trading high taxes for a 2-hour commute and a lower quality of infrastructure. It is a state that is growing faster than it can handle, and the residents are the ones paying the price for those growing pains. Let's keep moving south to number 6. Number 6 is Florida, the Sunshine State. With a GDP of $1.7 trillion, Florida is an economic juggernaut. It has no state income tax. That is the headline that brings millions of people down to the peninsula. They think that by moving to Florida, they are instantly giving themselves a 10% raise. And on paper, that is true. But Florida has a crisis that is quietly destroying the savings of its residents. We are talking about the insurance crisis. Florida is in the middle of a property insurance meltdown. Premiums in Florida are 3 to 4 times higher than the national average. In some coastal zip codes, you aren't looking at a normal insurance bill. You are looking at $6,000, $8,000, maybe even $10,000 a year just for basic coverage. And that is if you can even find a company willing to insure you. Many major insurers have pulled out of the state entirely. So you are forced onto the state-run insurer of last resort, which offers less coverage for more money. Think about the math on that. You save a few $1,000s on income tax, but then you turn around and write a check for double that amount to your insurance agent. You aren't saving money. You are just shifting who you pay. You don't pay the IRS. You pay the insurance adjuster. The sunshine tax is real, and it is mandatory. And it isn't just homeowners insurance. Car insurance in Florida is also among the highest in the nation due to high accident rates and litigation costs. So before you move to Florida for the tax break, make sure you do the full math, because paradise has a very steep price of admission. Now let's look at the other giant of the South. Number 5 is Texas. Everything is bigger in Texas, including the economy. With a GDP of $2.7 trillion, Texas is a monster. It is the energy capital of America. It is a growing tech hub. It is a manufacturing powerhouse. And just like Florida, it boasts that beautiful 0% state income tax. People are flocking to Austin, Dallas, and Houston to escape the tax burdens of the coastal states. But Texas has a dirty little secret that they don't put on the brochures. To make up for having no income tax, Texas levies some of the highest property taxes in the United States. The effective property tax rate in Texas is nearly double, and in some cases triple, what you would pay in other states. Let's run the numbers. If you buy a $500,000 house in a state with low property taxes, you might pay $2,000 or $3,000 a year. In Texas, that same house could cost you $9,000 or $10,000 a year in taxes. And here is the dangerous part. In places like California, your property tax is mostly locked in when you buy the house. In Texas, your property tax is based on the current market value. So if the value of your home skyrockets, your tax bill skyrockets right along with it. We have seen retirees in Texas who have paid off their homes years ago. They should be secure. But because their neighborhood became popular, their property tax bill doubled or tripled in a few years. They are literally being taxed out of their own paid-off homes. So don't let the lack of income tax fool you. The government is going to get its money one way or another. In Texas, they just take it from your house instead of your paycheck. Now we are getting into the top 4. These are the heavyweights. And number 4 might surprise you. Number 4 is Ohio. Yes, Ohio. With a GDP nearing $1 trillion, Ohio is a massive economic force. It is a leader in manufacturing, in healthcare, and in logistics. But Ohio is on this list for a very different reason than the others. Ohio might be the only state on this list where the rich state label actually benefits the average person. Why? Because it is cheap. Ohio is one of the few places left where a normal, middle-class salary can actually buy you a high quality of life. Your dollar in Ohio goes 40% further than it does on the coast. You can buy a mansion in a suburb of Columbus for the price of a studio apartment in New York. You can have a backyard. You can have savings. You can take vacations. You don't get the ocean. You don't get the mountains. You don't get the glamorous nightlife of Miami or Los Angeles. But you get to keep your money. You get to live without the crushing anxiety of living paycheck to paycheck. If you want to actually feel rich on a middle-class salary, you don't go to the places that are famous for being rich. You go to a place like Ohio. It is the control group in this experiment. It proves that GDP isn't everything. Affordability is what actually determines your happiness. But now we have to leave the safe haven of Ohio and go back to the gilded cages. Number 3 is Washington State. Washington is the home of modern tech giants. Amazon, Microsoft, Starbucks. It has a massive GDP per capita. There is incredible wealth in the Seattle area. And Washington is another state with no income tax on wages. But the cost of living in Washington has exploded to levels that are almost incomprehensible. Unless you are a high-level software engineer, The cost of housing in the Puget Sound region is suffocating. And while they don't tax your income, Washington has a very regressive tax structure. They have high sales taxes. They have high gas taxes. They have all sorts of fees that hit working class people the hardest. It is a state that is designed for the wealthy tech elite. If you are in that club, it is a playground. The nature is beautiful, the city is vibrant, and the opportunities are endless. But for everyone else, it is a constant struggle to keep up. You are competing for housing with people who are making massive stock bonuses. You are paying top dollar for everything from groceries to gas. It is a state of haves and have-nots, and the gap is getting wider every single day. Now we reach the top two. These are the true titans of the American economy, and they are also the most dangerous places for your personal finances. Number 2 is New York, the Empire State. With a GDP of $2.3 trillion, New York is the financial capital of the world. It is the center of media, fashion, finance, and culture. There is more money flowing through Manhattan in a single hour than some states see in a year. But New York is also the hardest place in America to survive. The cost of living here is not just high, it is punitive. Let's look at a statistic that came out recently for 2025. If you earn a salary of $100,000 in Manhattan, that sounds like a lot of money. To most of the country, 6 figures is the benchmark of success. But in New York City, after you pay federal taxes, state taxes, and the special city tax that you pay just for living there, and after you adjust for the insane cost of rent, groceries, and transportation, that $100,000 salary has the purchasing power of just $30,000. Let that sink in for a moment. Making 6 figures in New York is the mathematical equivalent of making near-poverty wages in a cheaper state. You can be a high earner on paper and be working poor in reality. The average rent in Manhattan is hovering around $4,500 a month. That is $54,000 a year just for a roof over your head. That is after-tax money, so you have to earn $80,000 or $90,000 just to pay the rent. New York is a machine that is designed to extract maximum value from its residents. It is a place for making money, but it is not a place for keeping it. It eats your wealth before you even have a chance to see it. And finally, we arrive at number 1, the biggest economy in the United States. Number 1 is California. California is a beast. With a GDP of $4.1 trillion, it is in a league of its own. If California were an independent country, it would be the 5th largest economy on the entire planet. It would be bigger than India. It would be bigger than the United Kingdom. It has Silicon Valley, the engine of the global tech industry. It has Hollywood, the center of global entertainment. It has the Central Valley, which feeds half the nation. It has everything. But it also has the most shocking statistic on this entire list. There is a measurement called the Supplemental Poverty Measure, or SPM. Unlike the standard poverty rate, the SPM takes into account the cost of living. It factors in how much it actually costs to buy food and pay rent in a specific area. When you look at the standard poverty rate, California looks average. But when you use the Supplemental Poverty Measure, which accounts for the insane cost of housing in California, California has the highest poverty rate in the United States. Nearly 19% of Californians are living in poverty when you adjust for costs. Think about the irony of that. The richest state in America has the poorest people. This is the ultimate paradox of the economic Avengers. These states generate trillions of dollars in wealth for the headlines. They make the stock market line go up, but they create poverty for the people who actually live there. They have created an environment where a normal, hard-working person cannot afford a basic standard of living. You have tech billionaires living 10 minutes away from tent cities. You have teachers and firefighters who have to commute 2 hours because they can't afford to live in the communities they serve. It is a broken system. So what is the takeaway here? What should you do with this information? The lesson is simple. Stop chasing GDP. Stop moving to states just because you see a news report about how strong their economy is. A strong state economy does not equal a strong personal economy. You need to run your own numbers. You need to calculate what we call your real personal income. Take your gross salary, subtract the federal taxes, subtract the state income taxes, subtract the property taxes, Subtract the hidden costs like insurance premiums and toll roads, and then divide what is left by the cost of a square foot of housing. That is your real number. That is your real wealth. And when you do that math, you might find that the poorer states are actually where you can live a rich life. You might find that a $60,000 salary in Ohio or Pennsylvania gives you more freedom than a $150,000 salary in New York or California. In 2025, the goal isn't to live in a rich state. The goal is to live in a state where you can get rich. And usually those two things are mutually exclusive. Don't let the glossy maps fool you. Don't let the GDP numbers trick you. Move for the margin, not for the money. Because at the end of the day, you can't pay your bills with your state's GDP. You can only pay them with the money you get to keep. Thanks for listening.